Afternoon, folks. It's Dave Burrows, Chief Strategist and President here at Barometer Capital Management. I want to thank everybody for tuning in today. Lots to talk about over the course of the last week. And of course, looking forward, we got CPI data tomorrow, which people care about. A lot of consideration as to whether the May Fed rate decision may be a hike and maybe the last hike. Some belief that we may go beyond there. And of course, how will the market react to the CPI data tomorrow? Inflation has been pretty sticky, although we've seen it coming down in some corners, specifically around goods. How will markets react? There's a ton of cash sitting on the sidelines. There is still a very bearish sentiment in the market. When we look at positioning, most investors are positioned very defensively. Coming into the CPI data, we've got a market backdrop that I think continues to be pretty constructive. This is the S&P back in the early 1980s. You can see that through the 80s and 90s, the S&P had several corrections along the way, but remained above the rising 200-week moving average. Over the period 2000 through 2013, we had a very choppy market. We had two major bear markets, 2000 through 2003 and 2008 through 2009, two markets we'd like not to go through again. And eventually, of course, we got out of that secular bear market in 2013, and we've remained above the 200-week moving average ever since. We started into a bear market in January of 2022, following a sell-off that started in unprofitable tech in February of 2021. So that's over 2 years ago now, 15 months into the S&P bear market. We're sitting now about 13% below the highs. And of course, we've been working our way higher since we made the lows in October. So we have challenged that 200-week moving average a few times, but we have seen a series of higher lows, and we continue, I believe, to be in a structural bull market. It's really important to keep that in mind because what comes after these bear markets are consistent rising markets, and we want to be there to participate. And our job as a manager is to find ourselves to the parts of the market that have a tailwind, the parts that matter. When we look at fixed income, we've made the point now for a long time, we think we saw a generational low in interest rates in 2020, much like we did in the early 1950s, late 1940s. And we are more likely in a series of higher highs and higher lows in rates going forward than headed back to those very low generational lows. In fact, we know that it was a very difficult time in the bond market last year, and for good reason. We had the first reversal in long-term trend in interest rates going back to 1981, and the TLT, which is the long end of the U.S. bond market, fell from a high in 2020 to a low in the late part of the fall 2022, a 48% decline in that ETF holding long-term U.S. Treasury bonds. Bond prices have bounced a little bit since then, but we've been making lower highs. We remain below long-term falling moving averages, and the bond market has been unable to put up any kind of major returns since we saw the lows in yields in October, certainly stocks acting better. But a very, very tough year last year. We just continue to believe that we are not in a constructive market for bond investors other than holding very short-term bonds, probably something to avoid, an asset class that does not have a tailwind. When we look at the S&P versus bonds, it's been, like I said, bull market since 2013. This has been the asset class to own over that period. And that makes a lot of sense. But we have seen changes. We saw a secular low in commodity prices in 2020. This is an important asset class. And you can see that it's been rising now since the spring of 2020. We consolidated over the last many months, came to the end of a consolidation, and commodities once again have started to break out higher. So this is really important because this is a tell. If the concern is a hard landing, maybe there's a hard landing, but it would be unlikely that commodity prices would be firming if we were headed to a hard landing. And certainly over the last few days, we've seen a significant pickup again in the bid in various commodity prices and commodity producers. And that's something to keep an eye on. Our view was that likely we'd come out of this consolidation and start moving higher. I know it's felt like many, many months of consolidation, and it has been, but we're at the beginning of a structural bull market, not the end. If we look at Brent crude, from 2015 through 2022, we traded in a range. Of course, we went virtually to zero at one point during 2020. We broke out, again, consolidated. This reversed higher over the last month, which again points to a continuation in the new bull market in energy. When we look at gold, gold rallied sharply from 2001 through 2012. And during the bull market in stocks really has underperformed. We consolidated this price pattern and again, broken out over the last month. So oil and gold and silver all breaking out on a relative basis versus equities. And when we look at gold versus the S&P, after a long drought, we've seen this group turn. So look, I understand that after a long period of underperformance, assets become underappreciated and unloved, probably underowned. But when they start to relatively outperform, you really want to take notice, because our job is to go to what will work and what is working, not what we think should work. So certainly a major shift for many of the major commodities and commodity producers. And that's an important factor when we're looking forwards and trying to square up with what the general opinion is in the market. And very often consensus gets it wrong. When we look at the commodities index, the Goldman Sachs Commodities Index versus the S&P, underperformed from 2011 through 2020, has been rising since then, certainly consolidated over the last few months again. This is one that we would expect to resolve higher as well. So broad-based commodities versus the bond market, again, rising since 2020, consolidating through from midway through 2022, May, June. And here we are in March, April, and looks to me like we're ready to move higher. So the beginning of what is likely a structural bull market in commodities. US dollars, I think something important to watch. We've been talking about this over the last few webcasts. US dollar is seen as a safe haven. It's also seen as a place to go if the belief is US interest rates increase more than global rates. And the US dollar rallied all of the time the S&P was selling off until October of last year. We know the S&P put in an important low at that point. Since then, the US dollar has been weakening, broke trend, broke support, broke the long-term moving averages, and made a low in the beginning of February. We know the stock market corrected through February into March, and US dollar had a bounce, was unable to regain its strength, and has begun to sell off again. So again, a tell that maybe there's a little more risk appetite. Maybe there's a little less concern about sharply rising interest rates in the US. And some of the assets that are priced in US dollars have started once again to outperform, specifically commodity prices. So not tons of data to talk about here, but the most important data over the last week with the non-farm payrolls that of course came on Good Friday, came in warmer than expected, meaning lots of new jobs, and that's sort of a surprise. For the people who are looking for a significant pullback in employment, this is a fly in the ointment. So what's the next data point we have to watch? Well, CPI coming tomorrow. CPI expectation is it'll be up 0.2. That's what the Fed wants to see. We put in a new data point for this month coming up, and we take off a 1 year ago data point, which was a big number. So the expectation is that CPI comes in at up 0.2. We'll see where it comes in. We'll see where the market reacts. But I think most importantly, we have to understand the setup coming in. Now, we don't care so much about what everything in the index does. We're not passive investors where we own a little bit of everything. We think our job is to be targeted. So it's really important to identify where the leadership is in the market. We want to find areas of the market that have a structural tailwind, where money is getting put to work today. Investors around the world have as much data as they can put their hands on. They look forward and try to guess where things are going next. And ultimately, you can take a lot from what the market is actually doing. There will always be groups that, for whatever reason, are behaving better than the rest. And we want to identify those themes early and focus in those areas, the areas with a tailwind, things that can be positively revalued. We're always looking for new signs of new leadership, and that could be specific sectors or themes or asset classes. And we recognize sometimes there's no leadership or there's a lack of leadership, in which case we'd better be prepared to play defense or have some money on the sidelines. So what we bring to the table is a tactical approach. We have tools that we use and processes that we follow to try to identify where in the market are the friendly neighborhoods and which ones maybe do we want to avoid. We use 3 sets of tools, and not to spend too much time on it. 70% of return in a portfolio comes at the hands of finding the right asset classes. In this case, we believe right now equities and commodities. Second, our job is to find sectors or themes within those asset classes that for whatever reason have a tailwind. And with those 2 pieces we address using our top-down models, where we're trying to find specific neighborhoods within the market that are showing improving breadth, or in other words, where participation in strength is broadening, more and more money is getting put to work. So these are our big picture themes that we're trying to identify. Now we have to find ideas to use to express that view, securities. And so our bottom-up work is done by our analysts who do due diligence and screen 60,000 securities daily, looking for securities that have improving business fundamentals, an improving technical picture or price behavior, because we want to play the piano with both hands, and where we can find securities that meet our business tests, things that are good, getting better, in areas of the market that we believe have a tailwind. That's where our portfolio should live. Now, that's a living, breathing thing. A portfolio needs to be reevaluated every day. I can tell you at our shop, every position is reevaluated every day based on our set of tools. And if for some reason those positions no longer meet our tests, they got to leave the portfolio. So if technically they aren't behaving the right way and hit our stop losses, the positions are gone. If our sector work changes and starts to show weakness, we'll carve back our exposure. If our market risk work shows us there's increased risk in the market, we're going to be more cautious. All of this work is driven by breadth-based models. Where is their expanding breadth? And then, of course, in which parts of the market are we seeing deteriorating breadth? Where we see deteriorating breadth, we will raise cash, we'll tighten up our stop losses, and we don't put any new money to work. You can't avoid being wrong for a few weeks at a time. You can avoid being wrong through a long bear market. When things start to weaken, if you use stop losses, we make sure the little mistakes don't turn into big ones. And it's not always easy, but the job is try to minimize the losses and take full advantage of the positions that work. So let's take a look at the world as it is today. A week ago, we talked about the fact that our breadth-based models for the NYSE, after 4 weeks of deterioration, showed a very nice bounce in breadth. Percent of stocks trading above the 10-week moving average had moved higher. Percent of stocks within the market that had positive weekly momentum had improved. Percent of stocks making new lows versus new highs had improved, and percent of stocks trading above their 150-week moving average had gotten better. Let's fast forward to this week. Breadth has improved further. Percent of stocks in uptrends globally has turned positive. Percent of stocks trading above with positive weekly price momentum moved higher, and percent of stocks trading above their 150-day or 30-week moving average improved. So forget about the headline index numbers, which very often are driven by the 7 or 8 biggest companies in the market. We want to know what's going on under the surface. Are more companies participating in strength, or are fewer? If breadth is deteriorating, we got to be more cautious. But this very clearly tells us internally the market is strengthening and we need to participate. Now, this is the S&P 500 index chart. Started correcting in the beginning of 2022. Made a low in June, made a lower low in October, but then something happened. We rallied, pulled back, and made a higher low in December. We rallied, pulled back, and made a higher low in March. So now we've got two higher lows and a higher high. Something shifted. We broke the downtrend that in place through the course of the bear market. We've seen improvement in breadth. And all you can do is to continue to assimilate new information. Now, in the past week, we had a very strong uptick in the number of advancers versus decliners. The percent of stocks advancing versus declining made a very significant statistical outcome. So there's something called a swag breadth thrust, or a significant 10-day improvement in breadth. It's happened only 14 times since 1950. And the S&P 500 was higher a year later every single time, up on average more than 23% a year later. So looking at the data, and I know this is hard to see, this data comes from Ned Davis Research. I'll show you all of the occurrences going back to 1950. Two of them in 1962. One of them in 1974, one of them in 1976, one of them in 1981, one of them in 1986. Moving forward, you can see all of the data points were followed by a significant advance in the market. You can bet that every time you'd been through correction, people felt badly. And you can bet a lot of people got stuck sitting on cash. The average 3-month return after a swag breadth thrust is 8.3%. The average 6-month return, 17.2%. And the average 12-month return, 23%. And the 6-month and 12-month positive returns are 100%. So when breadth starts to improve, strength builds on strength. Yet how are people positioned? Speculators have record net short positions against the S&P. There are more short positions in S&P futures than any time going back to 2011. Well, that's just the way that it works. People get to maximum bearishness often after the market has bottomed. So what does it mean? It means that if the market rallies, they probably need to cover those short positions. Not to mention the fact we know there's lots of cash sitting on the sidelines. So what is happening is breadth is improving. There's been lots of bad news that could take the market lower, but the market has been resilient. But despite the fact the market's been resilient, there's a lot of people been shorting the market. So that's an imbalance. So let's talk about leadership for a minute. When we take breadth down to the sector level, I can tell you that the average sector has 38% of their issues in clearly defined uptrends. This data has been moving to the right, meaning the percent of stocks in uptrends has been improving. We see the sectors to the far right, the ones with the broadest strength. It includes things like industrials, aerospace, and steel. It includes Wall Street financials, the broker-dealers. It includes insurance companies. It includes machinery companies. It includes basic materials, including chemicals. It includes auto producers. It includes oil and oil service, all highly economically sensitive groups. So does everybody just have this wrong? Or are people looking out 8 to 10 months and thinking maybe things will start to get better? People are positioning. So let's look at the sector work. The obvious weakest sector over the last few months has been the financials, led lower by the regional banks. This is the KRE ETF. It basically fell off a cliff in the middle of February when Silicon Valley Bank Corp failed. Now, fortunately, we didn't come into this period with any short positions, any long positions. So the reality is this was not difficult, but it had knock-on effects in many of the financial services companies. Our big weight in this group is in insurance. You can see made a substantially higher low in March than it did in September, October. has had a significant bounce back above the rising 200-day and 150-day moving averages. And that's for the group. If you look at the individual positions, and this is a ETF made up of about 100 different insurance companies, some better, some worse. Our big position is Progressive Insurance. Now, the breadth model for the insurance group turned positive about 2 weeks ago, while the financials group continued to be difficult. This is a chart of Progressive versus the KIE, which is the insurance ETF. A rising chart means that it is outperforming. So Progressive has been outperforming the insurance ETF since early last year and all the way through the bear market. Let's look at capital markets. Capital markets bottomed in October. This is the capital markets ETF, KCE. Made a low in October, a higher low in December, a higher low in March, and again, trading above the majority of the moving averages. This is an improving picture. So bottoming processes aren't a straight line. There's going to be some nasty surprises. The nasty surprises in financials were the regional banks, some of them with some very specific problems. We talked last week about the large banks like Royal and JP Morgan, two positions in our top 10 holdings at the firm, and how much they have outperformed. They've basically been about the two best large cap banks you could own in the banking sector. This is the capital markets banks versus the regional banks. Capital markets banks, including JP Morgan and Morgan Stanley, significantly outperforming since October and continue to outperform. So certainly some challenges in financials, certainly a setback in the month of March, but in the rate corners, some good relative strength. Let's move beyond financials. This is the XLK ETF. This is large cap tech. We talked last week about the fact that we're seeing some relative improvement versus the S&P since the beginning of the year. And while I still have some skepticism based on the valuations they're trading at, large cap tech is performing well. Now, we happen to own Microsoft, Apple, NVIDIA, Broadcom, and Cisco, the top 5 holdings in this ETF. We also own Oracle, which is the number 9 position in this ETF. We own them because we own dividend growth stocks, not necessarily because it's pure tech, but certainly they're performing well. Moving beyond tech, industrials has been a big theme for us. Certainly we got tested in the month of March. We had a low in October, a higher low in December, and again, a higher low in March. And again, these are slowly going through a bottoming process. June, October, December, March. Looking inside the industrial sector, we know certainly that aerospace and defense has led the way. And this is a theme that we've talked about now for 18 months. But what I've done on this chart is we've shown the price chart for the sector. This is the ETF ITA, which owns companies like Lockheed Martin, General Dynamics, and Raytheon. We can see that we're trading above long-term moving averages that are rising. We are just 3% from 52-week highs. And if you go back to the beginning of the bear market in January 2022, this ETF has outperformed the S&P by 23%. So this group continues to lead. We get a strengthening market. We want to know which groups have good relative strength, which groups are outperforming, because at the beginning of a new bull market, we want to see where the strength is coming from. So we've got strength in tech, we've got strength in industrials, and within industrials, aerospace and defense doing well, but also mid-sized industrial machinery companies. We know that there's a major theme to move manufacturing back to the US. I listened to an interview this morning of a contracting company that builds manufacturing facilities, and they said they have record backlogs. This is an ETF of companies that produce manufacturing equipment. Again, it actually made its low in June prior to the market's low in October, where it made a higher low in December, higher low in March. So this group showing good relative performance. Let's move beyond industrials. Energy is an important sector for the Canadian market. It's still a relatively small sector within the S&P, but my guess is it's an important sector going forward. We went through a bear market from 2014 through 2020. Market started to rally. We finally came out of the consolidation in 2022. And during the bear market, the S&P oil consolidated. But recently, over the last 2 weeks, we've broken out of that consolidation to the upside, as we talked about off the top of the webcast. If we look at our biggest positions, our two largest energy weights are Meg Energy, trading within a whisper of a 52-week high, and Imperial Oil, again, trading within a whisper of a 52-week high. Imperial Oil, again, we own because it's a dividend payer, 2.4% dividend that's grown its dividend 15% a year over the last 5 years, and something that we continue to expect. So one of the less obvious places to go to in this world are the energy producers and the large resource producers that are diversified producers that have an inordinate ability to raise a dividend once you get into a commodity cycle. If we're in a commodity cycle, we want to participate in those rising prices, both through capital appreciation and through a rising dividend stream. If we're at the beginning of a structural bull market in commodities, this could go on for 10 years, and the appreciation could be significant. Let's look at the materials ETF, FXZ. This is an ETF made up of producers of steel and metals and cement, things you build things with. Materials are in short supply. After a long bear market in commodities, there was very little new production that came on. But we know the materials ETF bottomed in October, made a substantial higher low in December, a higher low in March, and now moving higher again. If we look at it from the beginning of the bear market, the beginning of 22, it's up 6%, while we know the S&P is still down 15%. We can see that it's had a 22% outperformance versus the S&P since January of 22. This orange line represents the cumulative outperformance. So it's not a straight line, and there have been ups and downs. This group is a volatile group, but the reason we're there is it is relatively outperforming. And again, we think we're early in a bull market, not the end. Now, there's lots of reasons why we're seeing strength here, even though maybe we've seen some economic slowdown. This is the global market share that Russia, India, and China produce in these major materials. So steel and coal at over 65%, right? Fertilizer at 45%, wheat at 42%. There's major production that come out of parts of the world that we are less friendly with today. Yesterday, Xi was in Brazil, and no doubt he's talking to Brazil about settling trades in yuan and having a closer tie from an import-export position with China. This has got to be a major concern for consumers of these goods and strong for pricing. The steel producers ETF, SLX, has outperformed the S&P by 40.2% since the beginning of the bear market in January of 22. That's counterintuitive if you think you're going into a recession. Again, like the other leading groups, making successively higher lows in the bottoming process that we've been going through. I know it's exhausting to hear the negative commentary that we hear every day in the press, but price tells the truth. Prices for these economically sensitive commodities are going higher, and the producers that make these things are behaving significantly differently than the S&P that we hear quoted every single day. Copper producers. This is the short-term picture of copper producers, the June low, October higher low in December, and a higher low in March. The outperformance versus the S&P since the beginning of the bear market is 25%. And we think this is the beginning because we've only just come out of a multi-year structural bear market in commodity producers. This is the copper ETF, COPX. And yeah, we've been going through a difficult market, but look, this group has rallied back very close to highs. And if we get on to new highs, again, early stage of a new bull market, and many of these, again, are dividend payers. Why is it that the pricing power is there? because companies have been underinvesting since the beginning of the bear market. Look at the difference in expansion capital spent since 2014. We know we need a lot of copper and nickel for EVs. We know the expectations for growth in production, but there isn't the copper and nickel available. That means prices have to go higher, and significant investment needs to be made in new capacity, which takes time to come on. Even the copper mines that are producing currently are struggling to continue to produce at the same levels because they've been underinvested in through the course of a bear market. So we have some large cap exposure to things like Teck and Freeport-McMoRan. But in our top 20 holdings, we have two mid-sized producers, Capstone Mining, which is a producer in the Americas, Mexico, the US. And it's a diversified producer, traded better than 90% of the companies in the S&P in the last 52 weeks. And it's a very clear uptrend in place. Foran Mining, this is a small cap, $1 billion in market cap, with a very large opportunity in Saskatchewan to build a significant world-class mine. We saw it today trade at a new 52-week high, traded at $4.10 is when we talked about over the last few weeks. So inside this difficult market, there are definitely things that we can be doing. Gold miners. Gold miners are now outperforming gold price itself. We need to see that to be in a true precious metals bull market. The GDX is up 29% in the period that the S&P has been going through its bear market. And we know there's lots of well-performing gold miners we talked about last week. Some of the obvious ones, Franco-Nevada, Alamos Gold, AGI, among others, Wheaton Precious Metals. So we always come back to this. How are we positioned? And are the groups that we're in behaving the right way? Certainly the financials took a shot in March, but I'm pleased to say that half of our weight in financials really is across JP Morgan, Morgan Stanley, and Royal Bank. And half of the exposure is insurance companies like Fairfax Financial and Progressive that are significantly outperforming the financial sector. Information technology remains an underweight, but we've come up from a very low weight at the end of last year through the end of the bear market to a 16% weight in large cap tech. Industrials is a significant overweight at about 13%. Materials weight has been rising over the last few weeks as the strength appears to be resuming in these producers. Energy is about twice market weight. And as we've been adding to those, we've been reducing our weighting in short-term government bonds, which, as we said, was a place to hold cash from a short-term perspective. The underweight side of things, real estate, utilities, healthcare, consumer discretionary, consumer staples, and communication services remain significantly underweighted in the portfolio. Now, looking outside of North America, it's important to recognize that global stocks, for the first time in the last 12-month basis, have outperformed US stocks since 2010. When that begins, it tends to go on for a long time. So in our macro portfolio, we have significant weights in Europe. European ETFs made 52-week highs today, trading better than 91% of the companies in the S&P. The Mexico ETF has been chopping its way higher, led by companies like América Móvil, Walmart Mexico, Fomento Económico, and Grupo Mexico, and Cemex. Japan, for the first time in many years, significantly outperforming the US. And so this relates to a larger global weight in our macro portfolio outside of materials in global stocks, even cryptocurrency now significantly outperforming the S&P. So assets that do well with a weaker dollar clearly are leading. There clearly are challenges to the US dollar. There is a lot of cash sitting on the sidelines, and there are things to do. Our macro portfolio is a diversifier. And some of the things that are in there are more volatile than the market itself. So I recognize that, but it's meant to be a diversifier. And all of these groups are set to perform well. Now let's take a step back. If the expectation is that there's a real problem in the market, the measure of volatility picks up. We saw the spike in volatility in 2020. We saw a spike in volatility in the beginning of 22. And as the market made bottoms in the spring, in June, again in October, and again in December, we had pickups in volatility. But we're now trading at the low end of the range going back since the beginning of the bear market. The market is healing. Credit risk is not elevated. The expectation that bond investors have for excess return to take credit risk is just not there. We think we continue to be in a structural bull market. Now, while we think that, that may not be consensus. And certainly I recognize it's not easy to go through these kinds of corrections, but they're a fact of life. This data is from Ned Davis. Volatility is the toll that we have to pay to invest. On average, the market pulls back 3% 7 times a year. 3 times a year, there's a 5% correction. About once a year, you get a 10% correction. Every year and a half, you get a 15% correction, which is certainly no fun to go through. And about every 3 years, you get a bear market. Well, we've been through a bear market. We said early on, the measure for a bear market tends to be 18 to 25%, unless you have a financial crisis. And at this point, there's still no evidence of a financial crisis. But it's hard to go through these things. But the truth is, we know they're going to happen. Yet over a long period of time, asset prices go higher. We said in September, after very difficult 9-month periods, and these are the worst 9-month periods on record, going back to 1950. Looking forward, 6 months out, in the vast majority of times, the market's higher. Well, we're now 6 months out, and the market is higher. 1 year out, in almost every case, the market was higher. 3 years out, the market's up on average 59%. And 5 years out, the market's up on average 118%. So those are just the numbers. When we look at Fed hiking cycles, these are what markets have done post the last Fed hike. Maybe May is the last Fed hike. Yes, you have 2000 where the market was lower 12 months later. But in all of the other cases, market was higher. But people feel bad. And people are short the market because they're afraid. We know there's a ton of cash sitting on the sideline because people are afraid. I'd prefer to go by the numbers. If things get more difficult, we'll get more defensive. But I can tell you, based on market internals, the market's ready to handle the news that's coming at it. And I think we are positioned in the groups that will benefit over the course of the next cycle that could go on for 2 to 3 years before we get the next significant correction. So with that, I'm just going to check and see if there's any questions. I won't have a moderator today, so you'll have to bear with me. Let's take a look. Give me a second. Questions. I got no questions today. How about that? We stumped the band. Look, we appreciate people tuning in. Market time is different than people time. When you go through a bear market, it feels like it goes on forever. And the most important thing we can do is do the work every week and try to identify the parts of the market that are likely to do well going forward. When you go through a bottoming period, the sectors that hang in better than the rest and that show strength early tend to be the groups that lead on the other side. I think we're well positioned in those groups, and I think there's lots of opportunity. If you're sitting on cash or you've pulled money out of the market because of all of the scary things in the newspaper, it's probably time to reconsider those decisions. If you'd like to have a conversation with us, certainly give us a call, send us an email. We'd love to talk to you, and we appreciate everybody tuning in. So with that, hopefully we'll see you again next Tuesday, and we'll be here every Tuesday at 4 o'clock. Hope you find it useful. Thanks, folks.